In May 2022, Kwon's Terra Luna cryptocurrency evaporated $40 billion in 72 hours, the fastest wealth destruction in financial history. Life savings vanished. Retirement accounts zeroed out. People lost homes. Some lost their lives. Just 1 week before the collapse, Kwon had mocked his critics on Twitter, calling them poor, and confidently dismissing warnings that his algorithmic stablecoin was a mathematical impossibility. He believed he had solved the unsolvable problem in finance, a digital dollar that maintained its value through code alone, without backing, without collateral, sustained purely by market confidence. The system worked flawlessly, until the moment it didn't. And when confidence broke, the mathematics turned brutal. This is the story of how a Stanford-trained engineer built a financial empire on a foundation of certainty, and how that certainty became the very thing that guaranteed catastrophe. Kwon was born in Seoul, South Korea, in 1991. Brilliant, ambitious, unshakable in his convictions. He studied computer science at Seoul's prestigious Daewon Foreign Language High School, then moved to the United States for Stanford University. At Stanford in the early 2010s, Kwon immersed himself in the emerging world of cryptocurrency and blockchain technology. Bitcoin had proven that decentralized digital money could exist. Ethereum had shown that code could execute financial contracts without banks. But Kwon saw a fundamental problem: crypto was too volatile to be useful as actual money. Bitcoin swung wildly. Ether fluctuated daily. No one could price goods in a currency that changed value by the hour. The industry needed stability. After Stanford, Kwon worked briefly in Silicon Valley tech, but the traditional corporate path bored him. He returned to South Korea in 2015 and co-founded Anify, a mesh networking startup. It failed within 2 years. The experience taught him that incremental innovation wasn't his path. He wanted to build something revolutionary. By 2018, cryptocurrency had captured the world's attention again. Bitcoin had hit $20,000 and crashed. Ethereum was scaling. And Kwon had found his obsession: algorithmic stablecoins. The concept was elegant. Create two cryptocurrencies that balance each other through market mechanisms. One stays pegged to the dollar. The other absorbs volatility. No need for banks, no reserves of actual dollars, just mathematics and market incentives. Critics said it was theoretically impossible, that you couldn't create value from nothing, that algorithmic pegs always broke under stress. Kwon believed he could prove them wrong. In January 2018, Kwon co-founded Terraform Labs with Daniel Shin in Seoul. Their mission: build Terra, a blockchain protocol with an algorithmic stablecoin called TerraUSD, or UST. The mechanism was deceptively simple. UST would maintain a $1 peg through an arbitrage relationship with Luna, Terra's volatile sister token. If UST traded above $1, users could burn $1 worth of Luna to mint $1 of UST, profiting from the spread and pushing UST's price back down. If UST fell below $1, users could burn UST to mint $1 worth of Luna, again profiting while restoring the peg. The system relied entirely on economic incentives. Greed would keep the price stable. No dollars in a vault. No collateral. Just code and human nature. From the beginning, Kwon positioned Terra as the future of money. He spoke fluent English, projected absolute confidence, and had the Stanford credentials that Silicon Valley investors trusted. Terraform Labs raised $32 million in early funding from Binance, Huobi, Dominoes and Partners, and Polychain Capital. The pitch was intoxicating: decentralized stable money that couldn't be controlled by governments or central banks. But the model had a fatal flaw that economists recognized immediately. Algorithmic stablecoins had failed before. Basis had shut down in 2018, Nubits had collapsed in 2016. Each followed the same death spiral. When confidence broke, arbitrage stopped working because no one wanted the volatile token. Burning UST for Luna only made sense if Luna had value. If Luna crashed, the entire mechanism imploded. Kwon dismissed these concerns publicly and aggressively. On Twitter, he cultivated a persona of arrogant genius. He mocked critics, posted memes, and famously said he didn't debate the poor. He believed his system was different, better designed, better incentivized, backed by a growing ecosystem of applications built on Terra's blockchain. And for a while, the market seemed to agree. Terra launched in 2019, but it was 2020 and 2021 that turned Do Kwon into a cryptocurrency titan. As COVID-19 lockdowns drove billions into crypto speculation, Terra's ecosystem exploded. The key catalyst was Anchor Protocol, a savings platform launched in March 2021 that promised 20% annual yields on UST deposits. 20%. In an era when US savings accounts paid 0.5%, Anchor offered returns that seemed miraculous. The mechanism was complex but the pitch was simple: deposit your UST, earn 20%, withdraw anytime. DeFi enthusiasts poured money in. Retail investors followed. By late 2021, Anchor held over $14 billion in deposits. UST's market cap soared past $18 billion. Luna, which captured value as the Terra ecosystem grew, skyrocketed from under $1 in early 2020 to an all-time high of $116 in April 2022. Do Kwon's personal net worth was estimated at over $10 billion. Terraform Labs raised another $150 million at a $1 billion valuation in January 2021, then $25 million more in July. By early 2022, the combined market cap of Luna and UST exceeded $40 billion. Kwon became cryptocurrency royalty. He appeared on podcasts, spoke at conferences, and commanded a devoted following on Twitter. He announced partnerships with major protocols, integrated Terra into dozens of DeFi applications, and even launched plans to buy billions in Bitcoin as a reserve asset for UST. The Luna Foundation Guard was established in early 2022, accumulating over $3 billion in Bitcoin and other crypto to defend the UST peg if necessary. Critics called it a Ponzi scheme. Where did the 20% yield come from? Anchor paid out far more than it earned. The shortfall was covered by Luna Foundation Guard subsidies, essentially, new investor money paying earlier investors. Kwon argued that Anchor was a customer acquisition cost, a temporary incentive to bootstrap adoption. Once Terra reached scale, real economic activity would sustain the yields. The problem was that scale required perpetual growth. The system needed constant new capital flowing in. And in May 2022, the capital stopped flowing. The first domino fell on May 7, 2022. An anonymous whale sold $350 million worth of UST on Curve Finance, a decentralized exchange. The sale was large enough to break UST's peg. For the first time in months, UST dropped to 98 cents. In a healthy market, arbitrageurs would have instantly bought the discounted UST, burned it for Luna, and restored the peg. But May 2022 wasn't a healthy market. The Federal Reserve was raising interest rates aggressively, ending the era of cheap money. Cryptocurrency prices were cratering across the board. Bitcoin had fallen from $69,000 in November 2021 to $35,000. Ethereum was cut in half. Risk appetite had evaporated. And UST's peg breaking, even slightly, triggered fear. Investors started withdrawing from Anchor. On May 8, over $2 billion flowed out. UST fell to 95 cents. Luna Foundation Guard deployed its Bitcoin reserves, selling hundreds of millions of dollars to buy UST and defend the peg. But the selling pressure was too great. More investors panicked. More UST flooded the market. The death spiral had begun. To restore the peg, users burned UST to mint Luna. But this massively inflated Luna's supply. On May 9, Luna's price began collapsing. It fell from $80 to $60. Then $40. Then $20. As Luna crashed, the arbitrage mechanism broke completely. No one wanted to burn UST for a token that was losing half its value every hour. UST decoupled entirely, falling to 60 cents on May 10. Kwon tried to halt the collapse. Terraform Labs proposed emergency measures, burning Luna to reduce supply, increasing minting capacity, deploying more reserves. Nothing worked. The mathematics were unforgiving. Each UST redeemed created more Luna. More Luna meant lower prices. Lower prices meant fewer people wanted to redeem. The system was designed to stabilize, but only if both tokens had value. When Luna collapsed, the mechanism inverted into a hyperinflationary spiral. By May 11, Luna was trading at $1. By May 12, it was under a penny. The supply had exploded from 350 million tokens to over 6.5 trillion. UST sat at 10 cents. In 72 hours, $40 billion had vanished. Millions of investors around the world watched their portfolios zero out in real time. The Terra collapse was not an isolated event, it was a contagion that tore through the entire cryptocurrency industry. Three Arrows Capital, a major crypto hedge fund, had over $200 million in Luna exposure. The fund imploded in June 2022, defaulting on billions in loans and triggering a cascade of bankruptcies. Celsius Network, a lending platform with Terra exposure, froze withdrawals and later filed for bankruptcy, trapping billions in customer funds. Voyager Digital collapsed. BlockFi required a bailout and eventually failed. The total damage exceeded $200 billion in destroyed market value across the crypto ecosystem. But the human cost was incalculable. Investors who had trusted Anchor's 20% yield lost their life savings. Retirees saw their nest eggs vanish. One investor in South Korea reportedly died by suicide after losing his family's money. Class action lawsuits were filed in the United States and South Korea. Prosecutors in both countries launched investigations. And Kwon disappeared. In the immediate aftermath, Kwon insisted Terra could be revived. He proposed Terra 2.0, a new blockchain that would fork from the old one and distribute new tokens to victims. The plan was widely criticized as inadequate, it offered pennies on the dollar to people who had lost everything. Then, in September 2022, South Korean prosecutors issued an arrest warrant for Kwon and 5 Terraform Labs executives on charges of fraud and violations of capital markets law. Interpol issued a red notice. Kwon's passport was revoked. But Kwon had left South Korea months earlier. He claimed to be traveling, never disclosing his location publicly. For months, he tweeted intermittently, insisting he was not on the run, that he was cooperating with authorities, that he had done nothing wrong. Investigators believed he was hiding in Singapore or Dubai. Terra's collapse triggered regulatory action worldwide. U.S. Securities and Exchange Commission Chair Gary Gensler called algorithmic stablecoins inherently unstable. South Korea passed stricter crypto regulations. The European Union accelerated its markets in crypto assets legislation. Terra became the cautionary tale regulators pointed to when arguing for government oversight. In March 2023, Kwon was finally arrested in Montenegro, caught at Podgorica airport attempting to board a private flight to Dubai using a forged Costa Rican passport. He had been on the run for 6 months. Both the United States and South Korea immediately requested extradition. Kwon remains in a Montenegrin prison as of late 2024, fighting extradition while facing fraud charges that could result in decades in prison. Terra's collapse exposed a fundamental truth about algorithmic stablecoins: they are not stable. They are confidence games dressed in mathematical formulas. Every algorithmic stablecoin operates on the same circular logic. The stable token holds its value because the volatile token has value, and the volatile token has value because the stable token is useful. The moment that loop breaks, the entire system unravels. It's not a bug. It's the design. Do Kwon's fatal mistake was believing that confidence could be engineered through code. He built a system that required infinite trust that arbitrageurs would always step in, that Luna would always have buyers, that growth would never stop. He fortified that trust with billions in Bitcoin reserves, with aggressive marketing, with 20% yields that seemed too good to be true because they were. And he reinforced it with his own unshakable arrogance, mocking anyone who questioned the model. But confidence, once broken, cannot be restored through code. When UST fell below $1, the logical response was to flee, not to arbitrage. When Luna began collapsing, the rational move was to sell, not to buy. Kwon had built a system optimized for good times that became catastrophically destructive the moment conditions changed. The economics were always unsustainable. Anchor's 20% yield was funded by inflation, by diluting Luna holders to pay UST depositors. The model required exponential user growth to avoid collapse. It was a Ponzi scheme by definition, though Kwon would never admit it. The aftermath has been brutal. Terraform Labs faces multiple lawsuits, including a February 2023 complaint from the SEC alleging fraud and unregistered securities sales. Co-founder Daniel Shin was indicted in South Korea in April 2023 for alleged fraud tied to Chai, a payment app associated with Terra's early ecosystem. Kwon's legal battles will likely stretch for years. If extradited to the United States, he could face decades in federal prison. If sent to South Korea, he faces similar criminal charges. Either way, his empire is gone. Terra 2.0 is largely abandoned, trading at a fraction of a cent UST, rebranded as Terra Classic USD, is worthless. Luna Classic, the remnant of the original Luna token, is a ghost chain. And the investors who believed in Do Kwon's vision are left with nothing but hard lessons about the difference between innovation and illusion. Do Kwon once called himself a builder, a visionary bringing decentralized finance to the masses. But in the end, he built a machine that destroyed billions in wealth and shattered trust in the crypto industry for years. Terra's collapse was not a black swan event or an unforeseeable accident. It was the inevitable outcome of a system designed to fail. A system that required infinite confidence to function was never stable, it was a countdown. The lesson is not that cryptocurrency is inherently fraudulent. Bitcoin has operated for 15 years. Ethereum powers thousands of applications. Genuine innovation exists in blockchain technology. But Terra's collapse proves that complexity can disguise fragility, that confidence is not a substitute for fundamentals, and that arrogance is not the same as correctness. Do Kwon believed he had solved an unsolvable problem. He believed his intelligence and his conviction were enough to override economic reality. He was wrong. The market delivered that verdict in 72 hours, and millions of people paid the price. Today, algorithmic stablecoins are largely discredited. Regulators scrutinize anything resembling Terra's model. The industry has retreated to collateralized stablecoins backed by real dollars in real bank accounts, slower, less revolutionary, but stable. Terra's ghost haunts every new DeFi protocol, every high-yield promise, every founder who claims to have reinvented finance. Do Kwon sits in a Montenegrin prison cell, awaiting extradition. His Twitter account is silent. His empire is dust. The man who mocked critics as poor is now a fugitive facing decades behind bars. And the investors who trusted him are left to rebuild their lives from the ruins of a system that was always designed to collapse. This is the fall of Do Kwon, a cautionary tale about the limits of code, the danger of arrogance, and the difference between confidence and stability. In the end, Mathematics don't lie, but mathematicians can.